Nobody warns you about winning. Every book about trading talks about how to handle losses, how to cut them, how to survive them psychologically, how to prevent the spiral. There are entire frameworks, entire careers built on teaching people about the danger of losing streaks and the damage they do to your decision-making. But almost nobody talks about the other side. Almost nobody warns you about what happens when things go right, when the trades are working, when every call you make seems to confirm that you've finally arrived, that you've cracked something, figured out something, that the years of study and discipline and expensive lessons have compounded into a genuine, reliable, repeatable edge. Almost nobody warns you that this moment, this specific, earned, evidence-based feeling of having gotten good at something is the moment you are most likely to do the most damage to yourself. Almost nobody warns you about confidence. Jesse Livermore made more money than almost any trader in American history. He also lost it, more than once, in ways that, when you study them carefully, trace back not to bad markets or bad luck or bad analysis. They trace back to good runs, to the periods when everything was working, to the months and years when his reads were sharp and his timing was right, and the account was growing in a way that felt inevitable rather than fortunate. To the specific, seductive, completely understandable feeling that comes from being right about markets repeatedly over an extended period. That feeling has a name: confidence. And Jesse Livermore believed, after living its consequences more than once, that confidence, in the specific context of financial markets, is the most dangerous thing a trader can possess. Not because confidence is wrong, not because the wins that generate it aren't real, but because of what confidence does to the one thing that made the wins possible in the first place. That's what we're unpacking today, completely, without flinching. Start with a question that Livermore turned over for years. Why do the best periods in a trader's career so reliably produce the conditions for the worst ones? This isn't a rhetorical question, it's an observation, one that Livermore made about his own career, that he watched play out in the careers of every serious trader he knew, and that has been documented consistently in the decades since his time. The pattern is so reliable, so consistent across traders of different eras and different markets and different methodologies, that it deserves to be treated not as bad luck or coincidence, but as a structural feature of how markets interact with human psychology. The best periods reliably produce the conditions for the worst ones, not eventually, not randomly, reliably, as a predictable consequence of the specific changes that extended success produces in the way a trader thinks and operates. Here's the mechanism. When you're building, when you're earlier in the process, when the methodology is still being refined and the track record is still being established, you operate with a specific quality of attention that is directly produced by uncertainty. You don't know yet if the system works consistently. You don't know yet if your reads are reliable across different market conditions. You're still gathering evidence, still testing, still open to being wrong in ways that would require you to revise the framework. That uncertainty is uncomfortable. Nobody enjoys it. But it produces something extremely valuable. It produces humility, genuine, functional, decision quality improving humility, the kind that makes you check your work, that makes you honor your stops, because you're not yet certain enough in your thesis to override them. That makes you wait for genuine setups, because you don't yet trust your instinct enough to act on less than full confirmation. That makes you size conservatively, because the consequences of being wrong don't feel abstract. They feel real and near and worth taking seriously. The uncertainty, for all its discomfort, is doing protective work. It's keeping the ego out of the decisions, keeping the rules in force, keeping the methodology clean. Extended success removes that uncertainty, and with it, the humility it was producing. Not all at once, not in a single dramatic moment. Gradually, the way sediment builds at the bottom of a river, imperceptibly, invisibly, until one day the depth has changed, and what used to be navigable isn't anymore. Livermore described this process, the gradual erosion of protective humility by accumulated success, in terms that are so specific, so clearly drawn from direct personal experience, that they read less like market analysis and more like a confession. He talked about the feeling of a winning streak in physical terms, the way the body changes, The way the mornings feel different when you wake up to an account that has been consistently right for months. The particular quality of confidence that isn't bravado, isn't performance, isn't the kind of confidence that insecure people display loudly, but is quiet, internal, the kind that comes from genuine evidence about your own capability. He said that feeling was real, that the evidence behind it was real, that dismissing it as arrogance or overconfidence would be dishonest, because it wasn't arrogance. It was a reasonable response to a real track record. But then he said something that took years and multiple expensive lessons for him to fully understand. He said the feeling was also in its quietness and its reasonableness and its genuine evidentiary foundation, a trap. Because the confidence that comes from an extended winning streak is not confidence in the process, it's confidence in the outcome. And those two things feel identical from the inside, but are fundamentally different in what they do to your trading. Confidence in the process means, I trust this methodology, I trust the rules, I trust the framework I've built for how to engage with markets. When conditions meet the criteria, I act. When they don't, I wait. The process has produced results, and I trust it to continue producing results if I continue following it faithfully. Confidence in the outcome means, I trust myself, I trust my reads, I trust my judgment in real time. The wins have proven that my instincts are reliable, that my analysis is sharp, that I can see things in markets that others can't. Therefore, when my judgment tells me something, even when the process doesn't quite confirm it, even when the criteria aren't quite met, my judgment is probably right. The first kind of confidence serves the methodology. The second kind replaces it. And the transition from the first to the second, the quiet, invisible shift from trusting the process to trusting yourself, is the moment that the winning streak begins to build the conditions for its own end. Let me be precise about what this looks like in practice. Because the shift doesn't announce itself, it doesn't arrive with a dramatic change in behavior. It shows up in small adjustments, slight modifications to established patterns, decisions that individually seem reasonable and that only reveal their cumulative effect in retrospect. The first place it shows up is in entry criteria. When the process was newer, when humility was still doing its protective work, the criteria for entering a trade were non-negotiable. The pivotal point had to be genuinely clear. The confirmation had to be real. The setup had to meet the full standard, not most of it, not approximately, the full standard. After an extended winning streak, the criteria don't disappear. They soften, almost imperceptibly. The trader who used to wait for full confirmation now acts on strong, partial confirmation. The trader who used to require the pivotal point to be unambiguous now enters when it's pretty clear. The trader who used to demand that every element of the setup be aligned now acts when most of them are. Each individual relaxation seems justified. The pattern recognition has genuinely improved. The reads have genuinely sharpened. The track record provides real evidence that the judgment is reliable. The slight loosening of the criteria doesn't feel like discipline erosion. It feels like earned efficiency, like the system has been refined through experience. But the criteria were never primarily about analytical precision. They were about probability management. They existed to ensure that entries happened only when the line of least resistance was genuinely clear, when the market itself was confirming the direction, when the odds were demonstrably elevated. Softening the criteria doesn't refine the process, it degrades the probability. Slightly loosened criteria means slightly lower probability entries, which means slightly more losses mixed into the winning run, which, when they arrive into the context of a trader whose position sizing has also changed, because that's the second place the shift shows up, position sizing. Livermore was explicit about this. He watched himself do it. He watched every trader he respected do it eventually. After an extended winning period, positions get bigger. Not recklessly bigger, not the kind of obvious size increase that a risk manager would immediately flag. Just incrementally bigger. A little more than last month. A little more than the guidelines technically specified. Again, each increment seems justified. The account is larger. The confidence is evidence-based. The methodology has been proven to work. Larger positions are the logical expression of greater conviction, and greater conviction is the logical product of a successful track record. Except that larger positions change the emotional experience of the trade in ways that change decision quality. A position that's 30% larger than usual doesn't feel 30% different. Under normal conditions, in a winning trade, the difference is barely noticeable. But in a losing trade, in the moments when the position moves against you and the decisions matter most, a 30% larger position activates the threat response machinery at a meaningfully higher level. The threshold that Livermore identified in our last episode, the individual loss level that triggers neurological compromise, gets crossed sooner. At a smaller percentage, move against the position. The combination of loosened entry criteria and increased position sizing doesn't announce itself as a system in crisis. It announces itself as a trader in form, operating confidently, taking larger, faster positions in setups that genuinely feel, as solid as anything in the track record, until they aren't. There's a specific trade pattern that Livermore identified as the signature of confidence-driven deterioration. He called it, not in these exact words, but in this essential meaning, trading the memory of the edge rather than the edge itself. Here's what that means. The edge, the genuine, probability-elevated, methodology-confirmed edge that produced the winning streak, existed in specific market conditions. Conditions where the line of least resistance was clear, where the pivotal points were unambiguous, where the tape was communicating in the specific way that the methodology was designed to interpret. Those conditions don't persist indefinitely. Markets cycle, volatility regimes change, the macro environment shifts. What was a clean, high-probability trading environment 6 months ago may have evolved into something choppier, more ambiguous, less accommodating to the specific approach that was working. A trader operating with appropriate humility, a trader still in the uncertainty phase, still gathering evidence, would notice this change, would observe that the setups were less clean, that the confirmations were weaker, that the trades were requiring more management, more patience, more tolerance of adverse movement before resolving in the expected direction, would adjust, would reduce size, tighten criteria, wait for cleaner conditions, or simply sit out. A trader operating from confidence, from the accumulated certainty of an extended winning run, is less likely to notice, or more precisely, notices but interprets the signals differently. Where the humble trader sees conditions have changed, the edge is degraded. The confident trader sees temporary choppiness, the edge is still there, I just need to be a little more patient. Where the humble trader sees this setup doesn't quite meet the criteria, the confident trader sees close enough. My read on this is solid. The confident trader is not being stupid. They're being consistent with the evidence they have. The evidence, the winning streak, genuinely supports confidence in the methodology. The problem is that the evidence is backward-looking. It tells you what worked in the conditions that have just passed. It doesn't tell you whether those conditions still exist. And the confidence doesn't encourage the kind of open, questioning, genuinely curious observation that would answer that question honestly. Confidence encourages action. It leans toward entry rather than patience, toward conviction rather than uncertainty, toward the familiar pattern rather than the new information. Livermore said it plainly. The confident trader is always slightly behind the market, always interpreting current conditions through the lens of recent success rather than through fresh observation. Always a step slow to recognize that what worked yesterday may not work today, because confidence is a posture oriented toward the past, and markets are always only right now. Now I want to take you somewhere specific, into a moment in Livermore's career that illustrates everything I've described, not as theory, but as lived experience, with real money and real consequences. The early 1920s, Livermore had been on an extraordinary run. His reads on cotton and grain markets had been consistently accurate over an extended period. His methodology was sharp. His confidence, again, not the performative kind, but the quiet, earned, evidence-based kind, was at a peak. And he was also, without fully realizing it, in the process of making every mistake the confident trader makes. His positions were larger than his guidelines technically justified. His entry criteria had been subtly relaxed, not abandoned, but softened to a degree that had become invisible to him because the recent results kept validating the softer standard. His attention to the broader market conditions, the macro picture, the credit environment, the signals that his methodology had always required him to monitor as context for individual trades, had narrowed slightly. Not because he'd stopped caring about those things, because his confidence in his reads had made the contextual checking feel less urgent. He entered a series of cotton positions that felt, from the inside, as well considered and well timed as anything he'd done in years. They were wrong. Not slightly wrong. Significantly wrong. The cotton market moved against him in a way that his recent experience had not prepared him to handle, partly because the market conditions had genuinely shifted in ways his backward-looking confidence had obscured, and partly because his larger-than-usual positions meant that the loss accumulated at a pace that accelerated the neurological compromise before his rules had a chance to do their limiting work. He was in the Stage 2 compulsive action phase, the phase described in our last episode, before he fully recognized that the transition had occurred. And by that point, several of the decisions that would define the depth of the loss had already been made. He lost a significant portion of his capital. Not everything, not the total wipeout that came later, but enough to constitute a genuine setback, enough to require a serious rebuilding period. What's important about this story is not the loss itself. Losses happen. They're a feature of trading, not an anomaly. What's important is where the loss came from. It didn't come from a failure of analysis. It didn't come from missing information or from a market that behaved in an unprecedented way. It came from a very specific sequence. An extended winning period produced genuine confidence. Genuine confidence produced subtle but meaningful changes in how the methodology was applied. Those changes degraded the probability of each individual trade by a small but real amount. And when the market shifted, as markets always do, the degraded probability and the oversized positions combined to produce a loss that was larger and faster than the methodology was designed to survive. The confidence didn't cause the bad trade. It created the conditions in which bad trades were inevitable. Here's the paradox that Livermore eventually articulated, and that I think is the most sophisticated insight in his entire body of thinking about markets and psychology. The winning streak doesn't just produce confidence, it produces the specific kind of confidence most likely to destroy the thing that caused the winning streak. Think about that carefully. The methodology produced the wins produced confidence. The confidence changed the application of the methodology. The changed application degraded the methodology's effectiveness. The degraded effectiveness produced losses. The losses ended the winning streak. The winning streak contained within itself the mechanism of its own termination. Not because of bad luck, not because of an external event, because of the predictable psychological response to success. A response so consistent, so universal, so deeply embedded in human nature that Livermore observed it in every serious trader he ever knew, including himself, more than once. He called it the trader's cycle. And he said understanding it, genuinely understanding it, not just intellectually acknowledging it, but feeling its structure from the inside, was more important than understanding any technical element of market analysis. Because the technical elements could be learned once and applied consistently. The trader's cycle would return, inevitably, every time a winning period extended long enough to generate genuine confidence. Every time the evidence of success accumulated to the point where the protective humility of uncertainty was replaced by the productive feeling but dangerous certainty of a proven track record. Every time. The question was never whether the cycle would come. The question was whether the trader would recognize it quickly enough and have built something robust enough to limit the damage when it did. So what did Livermore actually build? What was the practical response to a problem this deep, this embedded in the fundamental psychology of human beings interacting with markets? His answer surprised me when I first encountered it, because it wasn't a new rule or a tighter system or a more sophisticated analytical framework. It was something much simpler and, in its simplicity, much harder. He built a practice of deliberate doubt. Not the destabilizing, paralytic kind of doubt, that prevents action when action is warranted. Not the kind of doubt that makes you second-guess every decision and exit every position at the first sign of adverse movement. Deliberate doubt, structured, applied at specific moments to specific questions. After any period of extended success, after any stretch where the results had been consistently positive, Livermore would deliberately introduce a questioning posture into his process. Not instead of acting, before acting, as a required step between identifying a setup and entering a trade. The questions were simple, almost too simple, but the discipline of actually asking them and actually listening to the answers without the filter of confidence was genuinely difficult. Is this setup as clean as it feels? Not as clean as recent setups have felt, as clean as the standard I established when I was humble enough to demand the full criteria. Am I entering here because the methodology confirms it, or because I feel good about it? Those are different things. The first is a process signal, the second is a confidence signal, and confidence signals, in trading, are not reliable. Have market conditions changed since the methodology last proved itself? Not in an obvious, dramatic way, but in the subtle ways that erode probability without announcing themselves. Am I looking at the current market with fresh eyes, or with eyes trained on recent experience? Is this position size appropriate for the actual probability of this specific trade, or for the general confidence I feel after a winning period? These questions don't feel comfortable when the confidence is high. They feel almost insulting, like questioning work that the track record has already validated, like applying a standard that the results have earned the right to relax. That discomfort is the point. Livermore said the discomfort of deliberate doubt during a winning period is the closest thing available to the natural humility of uncertainty. It's manufactured uncertainty, artificial, consciously constructed, applied specifically because the real uncertainty has been replaced by confidence. And artificial uncertainty, applied consistently, produces much of the same protective effect as the real thing. It slows the entry criteria softening. It interrupts the position sizing drift. It keeps the contextual checking in place even when the recent results make it feel redundant. It maintains a thread of genuine questioning in a decision-making process that confidence would otherwise seal into comfortable certainty. It doesn't eliminate the confidence. It doesn't pretend the winning streak didn't happen or that the track record isn't real. It simply introduces a counterweight, a regular, structured practice of asking whether the confidence is serving the methodology or replacing it. There's a dimension of this that goes beyond the individual trader, beyond the personal psychology, and Livermore touched on it in his writing, in the observations he made about market cycles and the behavior of trading communities, in a way that I think is particularly relevant today. Confidence, he noted, is contagious, not just within a single trader's psychology, between traders, across markets, through the social environment of speculation. When markets have been rising for an extended period, when the aggregate winning streak of the bullish community has been running long enough to generate widespread evidence-based confidence, the same mechanism that distorts individual decision-making begins to operate at a collective level. Entry criteria soften across the community. Position sizes increase as accounts grow and confidence rises. The contextual checking that would identify changes in the underlying conditions gets replaced by the comfortable certainty of a proven trend. The deliberate doubt that protects individual traders is nowhere, because the social environment of a winning market rewards boldness, not caution, punishes hesitation, not recklessness, makes the careful, questioning, humble trader look like the one who is getting it wrong. Livermore watched this in 1929 more clearly than anyone. The confidence of the late 1920s bull market was not delusional. It was evidence-based. The economy had genuinely grown. Stocks had genuinely risen. The people who had been bullish had genuinely been right for years in a way that justified real confidence. The winning streak was real, and the winning streak had done exactly what winning streaks always do. It had relaxed the criteria. It had increased the sizes. It had filled the social environment of speculation with the particular intoxicating certainty that comes from being right for long enough that being right begins to feel inevitable rather than probabilistic. By the time Livermore was building his short positions in 1929, The collective confidence was so total, so pervasive, so deeply embedded in the financial culture of the era that the people who were still questioning, who were still applying deliberate doubt, still asking whether conditions had changed, still checking the contextual signals that the tape was providing, were not just in the minority, they were considered wrong. The confidence of the crowd had become its own form of evidence. The sheer scale of the agreement, the millions of participants whose own winning streaks had convinced them that the market would continue higher, felt like proof, like the most reliable kind of confirmation available. And it was the most reliable leading indicator of the crash. Not because crowds are always wrong, but because the specific kind of confidence that comes from an extended collective winning streak, confidence that has relaxed the criteria, increased the sizes, silenced the doubt, and made caution seem like error, is always eventually more fragile than it appears. The same mechanism, the individual scale and the collective scale. The same paradox. The confidence produced by success is the enemy of the discipline that produced the success. Let me bring this to where you actually live, to the account, the screen, the decisions. You've had good periods. Every trader who has stayed in markets long enough has had periods where things clicked, where the reads were right and the timing was sound and the account reflected a version of yourself that you wanted to believe was the permanent one. In those periods, something changed in how you traded. Maybe you noticed it at the time. Maybe you only see it now looking back. But something changed. The entries came a little faster. The criteria felt a little more flexible. The sizes crept up. The checking, the deliberate, somewhat tedious work of verifying that conditions still supported the thesis, that the probability was genuinely elevated, became slightly less rigorous. Not because you stopped caring, because you trusted yourself, because the track record said you could. And then the market changed. Or you changed. Or the alignment between your methodology and the current conditions shifted in the invisible way that alignments always eventually shift. And the confident trader, the one operating on the earned certainty of the winning streak, was slower to see it than the humble trader would have been, slower to recognize that the signal quality had degraded, slower to reduce size, tighten criteria, step back. That slowness cost something, maybe a lot, maybe enough to define a quarter or a year. That's the trader's cycle. That's Livermore's paradox. Not a warning about external dangers, about market crashes or news events or unpredictable volatility. A warning about the internal landscape, about the specific and predictable way that success builds the conditions for its own reversal. The market didn't do that to you. The winning streak did. And the winning streak was real and earned and deserved. That's the thing about this particular danger. It doesn't arrive disguised as something suspicious. It arrives dressed as reward, as the natural and appropriate expression of doing good work over time. It arrives as confidence. And Livermore, the man who made $100 million understanding exactly this dynamic and lost fortunes forgetting it, would tell you to treat it accordingly. Not with fear, not with the kind of self-undermining doubt that prevents decisive action when decisiveness is warranted. With respect. The respect you give something genuinely powerful, something that has done damage before and will do damage again if it's allowed to operate without the counterweight of deliberate, structured, regularly applied questioning. The practice of asking, is this the methodology talking or is this the winning streak talking? Those are different voices. They sound the same. They feel the same. One of them is the edge. The other one is the thing that ends it.